Hi Amit, wish you a very happy new year and welcome back to Capital Conversations.
Yeah, hi Ashutosh. Happy New Year to you as well.
So I think today, in continuations to the conversations earlier, we're going to talk about trading. So we spoke about the research, the investment management, portfolio construction side of it, asset allocations. Following from there, we've spoken about the risk management side of it, and I think the next logical step, as we discussed last time, would be to talk about trading. So before we dive into the nuances of the trading, and I know it's a very loaded word, like many others in this domain, uh, in very simple words, help our viewers understand what is trading.
Okay. So, trading essentially is buying and selling of uh, financial instruments like stocks, bonds, even real estate. I think we have been talking about that a lot. That trading could happen in their specific markets, which could be both publicly available exchanges or what we call as over the counter, where one to one trading happens. So, yeah, essentially, trading is where the final meat of what we have done so far, selecting a security, and then we actually buy and sell it on the market.
Right. So this is where the sort of rubber hits the road.
Right.
We've kind of done our research, we've constructed the portfolio, but now we are actively buying and selling under that portfolio.
Right.
But it seems like you spoke about the private assets, the ones that are exchanged on the on the exchanges, that are traded on the exchanges. It seems like from what we were discussing earlier, the life cycle of the trade is quite nuanced. It's not just a matter of buying and selling. So can
Right.
you walk us through what are the distinct stages of this whole trade life cycle?
Right. So essentially, trade life cycle is quite a lengthy process in that sense, in the number of steps. So probably I try to summarize it in as few words as possible. I think the trade life cycle starts when the investment decision is made by the fund manager or by the investor on what they want to buy and sell. And in a formal firm or an asset management company, as soon as you make an investment decision and you say, I want to buy or sell the security, the first step is what we call as pre-trade compliance.
Right.
So compliance is nothing a set of rules that could be enforced by the external environment, most likely the regulators, or your own internal rules that you have set for you as a firm in how much you want to buy or take position in any company or not. So when the first set of those pre-trade compliance rules are on any investment decision, the next step is that investment decision becomes an order, which then flows into our order management platform.
Right. So just so that I get it right, so what you're saying is now that I have constructed my portfolio, it's in play, and now that I'm actively trading on it, I don't want my portfolio managers or I don't myself to make inadvertent mistakes. So
I think
I'm
last
kind
time
of
we had talked about risk management, right? So
yes,
pre-trade compliance is one of those risk management tools that firms, especially asset management firms, actively employ
right,
to manage risk. So one example could be, say, you can't, as a firm, have more than 10%
right,
into one company, or we don't want to invest in a particular sector because that's what we don't want to do, or we don't want to invest in any companies which are registered or domiciled in a particular country because of international sanctions. Or
right.
so is this the first step
Okay.
where you just want to one of the risk management protocols?
And sorry, I cut you short in the middle of the flow, but where does this happen? So where is this compliance actually happening? Because if I'm trading on a terminal, where is this?
So again, depends on how complicated the systems of that particular firm or investor are. It could happen on what we call as the order generation platform, where the fund manager itself is taking an investment decision, or it could happen on the trading platform, or there what we also call the execution
Right,
management system. But essentially, it happens before. Ideally, it should happen before the order hits the trading desk.
right,
I think that is
right.
what pre-trade means. It's,
Okay, so probably we continue from there. So we got to the point of compliance.
Yeah, so it's compliance. If something compliance rule is broken, there could be a to and fro happening between the fund manager and the compliance team. They'll rectify it, and then once it passes the pre-trade compliance checks, it reaches the trading platform, the trader desk. The traders would be receiving orders from multiple investors in an asset management or a hedge fund. Could be multiple portfolio managers, or from a sell side or a brokerage firm. It could be multiple retail investors, institutional investors. So the first step, generally, what happens is what we call as an order merge. So if you're getting multiple orders on the same security from multiple places. They could even be in opposite directions. What we do is we try and stack up those orders on the same security and what we call try and merge them just to achieve efficiency or scale when we are trying
Right.
to.
So basically, it's like the internal consolidation of all the orders received before
So
they
it could
hit
be
the-
that I want to buy, say, 1,000 shares of Microsoft at a particular price. You want to buy Microsoft shares again at, say, 2,000 shares at a different price. So there's a stacking happen based on price and security
Right.
that try and merge. Okay, once that is done, the next step is what we call is order routing. So the orders need to be routed to their right market in a sense,
right.
Which is the right exchange where you can get the best price for your order. I think one of the key principles on which our trading desks are judged is what we call as best execution, right? They need to achieve the best execution price on behalf of their investors who are coming to them, and the right volume, because you also need to minimize the impact of, say, a huge order hits the market immediately. If the opposite counterparty senses your prices can move in an opposite direction to what you want.
Right.
So those are so you try and route the desk orders to the right desk, to the right exchange or to the right counterparty who gives you the best price, and also try and minimize the impact.
Okay. So I made up my mind. A lot of people sort of are sending orders to this sort of place where once the pre-trade compliances happen, all the consolidation happens. What happens next?
So yeah, this is
After
what
routing.
order routing is essentially, like I said, is when you then actually are sending the order to the market for execution.
Right. Okay.
This is the core philosophy. It's now going away from the trading desk to the real world where others
Which
can
in
also
this
start.
case, if it's market traded, is exchange, I assume.
Yeah. So essentially, the rest of the world can now see what you're buying or selling.
Right.
So
Okay.
you have now exposed your trading strategy to the outside world.
Okay.
Okay. Once that happens, is then typically on a exchange you have brokers where execution starts happening.
Right.
So suppose as a desk you have sent an order for 1 million shares of a particular company, then execution generally you won't see, depending on the liquidity of that particular stock and many other principles, you start executing those shares in different chunks.
Right.
And again, there are multiple principles of whether it's a limit order or a market order, whether you specified a price or not. Those executions will start. So it could even be the trading strategy. You break those million shares into very small number of shares to minimize impact.
Right.
And once those executions start happening with the counterparty, so a counterparty is nothing but, say you are the buyer, then the counterparty could be a seller.
Right.
And that seller could be a retail investor. In many of the cases, it's the sell side firms who also act as market makers.
Right.
In that particular security, they'll start, say, buying those shares.
Right.
As and when those executions happen, you keep getting what are called as fills from the brokers coming back to you, and you start seeing your order book, but your orders start getting filled.
Okay.
Based on.
So basically, are you saying that then once the brokers are executing these orders on my behalf, in real time, I kind of get to know how much is sold, how much is bought?
So for a retail investor who is, say, dealing in very, say, single digit or double digit shares, you will almost see an immediate execution happen within a single step.
Yes.
You probably don't even need to wait because most of these trades are now, 90% of trading is now automated.
Right.
But for big shares, it could take a much longer time for those executions to happen.
Right.
Or there is what we also call as a block trade, where, say, two big counterparties, they basically might execute the trade outside of the market because it's a huge chunk of shares moving.
Right.
They don't want to impact the market. So a lot of exchanges have given those facilities.
So what you're suggesting is, although it let's say is a security that is listed on exchange, so let's say Microsoft on, let's say, some exchange, but then they could engage into block trades which are happening outside the exchange.
But yeah, it's something, again, you need to inform the exchanges in advance that this is what we are going to do. You just, because otherwise you just would be violating your.
So it's a regulated process, not something that's happening under
the price needs to be transparent.
Fair enough. Yeah.
So once those fills happen, your order keeps getting executed. Now suppose theoretically the whole order gets fulfilled. Most of the time it doesn't, especially for big orders. Then the next step is allocations. So remember, we talked about merging orders in the beginning. Now you need to allocate those executed orders against those instruction that you have received from multiple people. There are different allocation philosophies that multiple companies follow. It could be based on largest orders, but again, you need to be very transparent with the allocation process. It needs to be democratized. You can't favor one party over another. So generally, it's a much more equitable process. It needs to be very transparent.
Right.
And especially for asset management firm, they can't be favoring their internal portfolios.
Right.
It always needs to be the
Right.
clients need
Right.
to be
Right.
favored.
Interesting.
Yeah.
Sorry, go on.
So once that allocation happens, is essentially now allocated those trades to the specific client accounts. Then what typically happens is what we call as a matching and confirmation process. Matching is nothing but the order that you have executed, you try and match it to the counterparties.
Right.
In terms of the price, the trade volume, and other parameters, they should exactly match. And then you confirm the trade with the counterparty. So there are most of this now, especially in equity world, is automated. OMGO CTM are one of the most common platforms where these trades, any discrepancies need to be resolved through back office operations where those are.
And this is more in the context of you saying like institutional investors or family offices, because like for example, when I'm doing my retail trading, I kind of never got into that kind of exchange.
I think you as a retail investor are not exposed to that.
Right.
But the broker through which you are trading will definitely do that with the counterparty.
So basically you're saying that if I placed an order, let's say to buy 100 Infosys shares, then some part of exchange is happening in real time over the exchange and I get to see like the feedback that my order is executed. But then the actual exchange behind the scenes, which is being facilitated by the brokers and the other counterparty, which presumably is the broker on the other side, is happening in the background.
I think that is the kind of support that brokers bring in, right? Otherwise, we could have traded on our own, but and this is with in future. I mean, we believe technology like blockchain probably could simplify the process, but I think it's still a way to go.
Right.
I think once that matching and confirmation happens, then it's the step of settlements and confirmations, where actually now, especially if it's not something an intraday trade, it's delivery versus payment. You need to, the buyer needs to pay the cash to the seller, and seller needs to deliver the securities. So all of that, again, settlement depending on the settlement period for that particular security, exchange, country. Settlement happens and the buyer and seller receive the respective payments.
And typically these settlements are happening like in, let's say, over the next day, or
again depends on the maturity of the markets and the asset class. Typically equities are going more and more towards T+1, or in some cases, if you know, in India, SEBI has even allowed same day settlement now. But typically depends on the exchanges, the type of securities. The OTC markets could be slightly different because no formal exchange involved. You are directly working one-to-one, but again, they follow a similar cycle. But the processes are less transparent compared to a completely publicly listed. Yeah, and the final step, if you might say, is just client reporting. It's typically from an asset management or a brokerage firm perspective, they need to, formal reports are sent to the clients. Okay, you've done the execution. Because then they will also be charging their fees, commissions, all of those are then calculated, and then the final. And when we were talking about compliance, you spoke about pre-trade compliance. Does that imply there is also an element of post-trade compliance? Yeah, sure, Ashutosh, I completely forgot that. So once the allocations are done, you do a post-trade compliance again. Again, you check for the positions that you have and whether they again not exceeded the limits that you wanted, because a lot of time, most of these trades are happening. They're not in motion, you don't know the exact trades once. So similar checks are done in post-trade compliance as well. Again, we have not exceeded any red lines that we have defined. Right. Okay. So that's quite a lot. It's not just a matter of just buying something or selling, because it looks very simple, at least for the retail traders. So it's good to know the details on that process. But you spoke about, this whole trade life cycle, and then you mentioned the buy side and the sell side separately. Are there any distinctions in terms of their objectives or the challenges that they face or the platforms that you have? Is there a distinction? Yeah, so buy side, I think we have spoken earlier, is more about the asset management firms and the hedge funds, and sell side is our brokerage firms. Yes. So because I think the objectives of those kind of category of firms itself are different. The trading desk also kind of inherits the same objectives. For buy side, the objective is always, because they're supporting long-term investment strategies for their portfolio managers, the main objective of the trading desk is to do trading which supports the investment strategy of the fund manager. It's more about achieving best execution, because they don't get paid on transaction, right? Their contribution is again part of the management fees that the fund as a whole is receiving from their client.
Right.
So again, it's about best execution in line with the investment strategy of the fund managers taking those investment decisions.
Right.
They don't have much control over what they want to buy or sell.
Right.
And they typically then will collaborate with the sell side brokers to actually execute those trades. For sell side firms, it's their revenue. It's more, I think there are a couple of things that their role they play. One of the big role they play is of market makers. Many of these big investment banks or brokers, they play market making in many of, especially blue chip and many of these firms, because then they quote both the buy and sell price, the bid-ask spread. That's where they make the money. A lot of.
So sorry to interrupt, but for our audience, can you explain what do you mean by market makers?
Okay, so market makers essentially say when you're buying or selling anything, right? You always have somebody else. So you're buying, somebody else is selling.
Yeah.
So you know the customer. Now, in this case, typically a very simple scenario would be a broker just would act as an intermediary between that buyer and seller, right? He's trying to bring both the parties together. But in case of market makers, the market maker itself acts as a counterparty, both from buying and selling, because they probably would have built their whole position in a particular company. So if I want to buy, the market maker generally would try and satisfy that order through their own position.
Right.
And they keep on publishing their bid and ask price or the buy and sell price on which they are doing the trading. And that is where they make their money. In most of these orders, this is how it is done.
Right.
Probably won't have an Ashutosh buying directly with Amit.
Right. So generally, they are not like passive participants. They are actually influencing that.
And I think they do bring it may sound like that it's not a transparent process, but they do bring a lot of liquidity in the market.
Yes.
Right?
And that's why the trades can happen actively. Yeah.
And then they make their money from the bid-ask spread that they have. Okay, the other key role where they make money is through transactions. Right. So every transaction they will charge a commission or a fees, which is then billed to the client.
Right.
And the third very key role which a lot of sell-side firms play, they'll publish a lot of advisory and research reports.
Right.
A lot of these trading firms or sell-side firms have their own research desk. They also send those. For many firms, they will send it for free, especially for the retail investors. But a lot of buy-side firms actually pay for the brokerage research. It might be built within the fees that they charge, but with more and more regulation transparency coming in.
Right.
Now this particular component is no longer part of the fees.
Right.
You have to explicitly say how much you're paying for third-party research. So sell-side firms have multiple sources of revenue, and that is what drives their trading behavior as well.
Right. So that's interesting. You spoke about, the fact that market makers are kind of, doing what you just suggested. But also when, let's say, a portfolio manager is placing an order, a lot of times if these are institutional investors, family offices, HNIs and so forth, probably the sizes of orders are quite significant. And that means that they have this inbuilt potential of moving the market one way or another. So how does one deal with these kind of fluctuations that might be brought in just because somebody else just trying to, let's say, dump the shares or let's say, increasing the stakes in a particular stock?
Right. You brought a very important point. I think this is where trading function plays a big role.
Right.
How do they actually execute
a
buy or a sell order that has come from their client? A client could be internal client, portfolio manager, it could be a high net worth client. Because if I suddenly push a big amount of, say, buy, which is almost equal to 1% of that company's equity, it could potentially move the price very high.
Yes.
So it's the skill of those traders. How do they break those orders into the market, keep pushing those so it doesn't have a huge impact?
Right.
But on the other side, with technology coming in, most of these people who have been able to invest in technology, there's a huge discipline, what we call as high frequency trading has just come in.
Right.
Which is a very specialized branch of algorithmic trading, where people have designed programs just to check for
Right.
these kind of orders. They're coming from a similar client, and they can start placing counter orders, which just to negate those. So it's a game of
Wow.
cat and mouse being played, but
Right.
who wins it?
Right.
Uh,
So you spoke about algorithmic trading, and there's a lot of, again, topic that can't be escaped in these conversations. It's like, the AI and all the, sort of advent of technological changes that are happening, blockchain around the corner, and so forth. How has these kind of changed the way trading has happened? You slightly touched upon it, but is there more to it?
so I think trading function in investment management was probably the first one to adopt technology in a big way. So
Right.
algorithmic trading has been there for a long time. If you see, almost probably 90% of the orders are today being traded by computers.
Right.
So it's an high frequency trading which has come in a big way, has been there for a very long time. It's now more about the computing power and how
Right.
best you can use it. I just heard a lot of firms have actually now gone away with their manual traders, and the trading desks are very small compared to what were there about 15, 20 years ago, because most of the trading is automated. So it's more about who has a better algorithm, who has a better
Right.
computing power. It's become a Game of Thrones between.
So that's very interesting. And does that also kind of mean that the probably is to some level, or maybe it's a double-edged sword, but at least some part of the risk could be sort of eliminated, handled better, because in the past there have been cases where, in some cases, some of these risks have played themselves out because of the human interventions. Whether they were intentional or not is another thing. I think you spoke about the Barings Bank in when we were speaking offline. So, can you talk about, is there like an impact? Has it changed, or are those risks
I
still
think
there?
it's algorithmic trading is can hit you both ways. Barings Bank collapse was is one of the big failures of not having the right risk management protocols within trading. Right, it's
Right.
a trader took up a huge position in a particular derivatives exchange. I think it was a Singapore exchange. The protocols didn't make it transparent. A huge position was taken. The management didn't even know about it. And when the markets turned the other way, the bank collapsed. It was almost,
Wow.
I think, more than $1 billion. Similar things have happened in recent times as well. But I think most of these cases have been, I think, one, generally have involved derivatives, which
Right.
people don't fully understand.
Right.
And then is about lack of adequate risk.
Was the London Whale example that you
Yeah,
talked
something
about
of that
was,
sort. Yeah, I think again led to $6 billion of loss.
and that was because of the derivatives?
Yeah. And I think if you've recently seen, even in India, SEBI has put a lot of emphasis. A lot of retail investors in India are using these online trading platforms. I should not say the online, these mobile trading platforms
Yes.
to delve into futures and options and instruments which they don't understand.
Yeah. I think a lot has been done, but I think part of that problem still exists because the way these brokers are incentivized,
Right.
on people having placed those bets, without understanding what does shorting a stock mean, and they would just call up people and they'll sort of
Yeah, I
use
think we
them.
have talked about this in our earlier sessions as well.
Yeah.
Please only invest in things you understand.
Yes.
You
So,
might see
guys,
others.
please invest in things that you only understand, educate yourself.
So and trading is the part where you actually, like you said, rubber hits the road, right?
Right.
There have even been cases of what we call as fat finger.
Yes.
You instead of pressing 1,000, you press two more zeros, and 1,000 then become a million.
Million. Yeah.
So I think just so all of these pre-trade compliance, post-trade
So I
compliance, these
worked
checks.
in one of these departments where we were in this meeting and everybody was laughing about particular kind of a process that existed where you know a- it was the number was punched in, but somebody else had to punch in the same number manually again, and then everybody was making a joke about how redundant that process is until somebody on the risk side educated that the process was brought in because somebody actually accidentally punched two extra zeros and the trade was sort of
Yeah,
sent
so
to the
these
market.
things
So
happen, and this is where risk management comes in. Yeah, with automation, you can reduce those,
yeah.
but automation can also be a double-edged sword.
Yes.
There have been crises which were triggered by completely automated trading. There was a flash crash somewhere, I think 2010, where the market just kept on trading in one direction for a particular security and the whole market collapsed
Yeah.
within a matter of few seconds. Right.
Yes.
So yeah, you need to. So whenever you're building any trading platform, need to
Yes.
be adequate risk control built within those
Yeah, and I
platforms.
think there is this whole thing about quite often when you talk to people, on the business side or sometimes in operations, they're very hell bent on this whole thing about automation and the cost that efficiencies that it can bring in, without fully appreciating that. you could just create something that you will sort of blindfolded to until
Yeah,
it plays
because
itself
risk
out.
management is considered as a cost.
Yes.
Yeah, it will always seen a negative onto your P&L.
Mm.
But I think you need those because, as you know, markets will not always go in one direction, right? It's been
Yes.
proven over the last 200 years when markets have existed, markets do come back to their mean
Right.
reversion. So you don't always expect markets to keep going the same direction. Something will go wrong. It's a normal distribution world. Something will go wrong.
Will go wrong.
So
Yeah.
you need to have the risk management
Right.
controls in place.
So, in sort of this, with such a pace and the amount of risk associated with, all of that we spoke about, what are the sort of non-negotiable sort of traits or skills from a trading perspective, whether it's retail, whether it's institutional, do you think are critical?
I think one thing definitely discipline. Because trading, I mean, I'm not sure if you've seen a trading desk. I mean, the amount of information that these guys get.
Yeah, they usually have these like
Big
8, 9
screen, and plus
monitors.
they're getting continuous information from external, internal
Yeah.
world. So you need to have discipline in your trading process. You need to have patience because a lot of time you will see you traded on something, the market is going in the opposite direction.
Right.
You need to have that emotional control.
Right.
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 So I think I would say these couple of discipline, patience, and a very high emotional quotient
Right.
are the definite must-haves for
And
somebody
you
who
say
wants to.
emotional quotient because of these people getting influenced by the fluctuations in the market and kind of
Yeah,
latching onto those
because you
sentiments.
get, like I said, you're getting continuous information, right?
Right.
And you can get overwhelmed in that, and you just start, okay, just I'll do what the market is doing, right? But
Right. Right. Right.
so you can get overwhelmed with that,
Right.
and it's a stressful job.
Yes.
I don't think everybody can do it for the rest of
That's very
the whole.
important point that you bring up, because I think the latest book by Yuval Harari, Nexus, he talks about this. More information does not necessarily mean that you
Right.
are going to make the right decision, because you need to put it in some kind of a context or a storyline, which is often driven by your own values, which is quite an old idea. But I think that's something that definitely
And
can.
trading, you're most of the time taking real time decisions, right? If you
Right. Yes.
don't have that discipline, that emotional control, you will face a burnout.
Yes.
And some of these markets, especially say if you're a trader on the forex market,
Yeah.
which are open practically 24/7,
Yes.
you
Yeah.
need to have that work-life balance at the end of the day.
Yes. Yes. Yes.
So I think, like I said, most of these skills are all those emotional, mental skills. I'm not even talking the hard trading skills. I think which
Right.
most of the traders who are getting that profession will have.
Would have. Right.
But the ones who are successful are the ones who have these
Right.
emotional stuff, right?
I think one thing, so I think that gave a very good context on the overall understanding of this topic. But I think one thing that we did not as much touch upon was that how does this whole trading thing work for the private assets? Because there's no exchange there, right? So,
Okay, there I will talk about two contexts. One is what we call as the over-the-counter trading,
right.
which generally happens with fixed income instruments and with derivatives, where you don't go to your regular exchanges. They're over-the-counter exchanges, which probably buyer and seller are directly trading.
Right.
And brokers do intervene. They probably create those contracts through which you can, but it's still not as publicly listed.
Right.
The other is the core private assets, the private equity and the private debt. I think because there is not so much information available, there's lack of transparency. There are a lot of legal teams which are involved in creating
Yes.
those contracts, right? Because you're probably trading for a much longer term.
Right.
And these markets are not very liquid; they're highly illiquid markets.
Yes.
So you need to enter into very precise legal contracts whenever you are, say, buying into either a private company or entering into a private credit kind of a situation. And because of lack of liquidity, again, you need to be, whenever you're buying or selling, the trading time could be much longer than compared to
right. The cycles are
public
longer.
listed market where there's complete automation. You just go and type some numbers and you buy or sell. Private market, I don't think there's too much of technology at the moment, because again,
Right.
but it's more of legal and regulatory aspects which are much.
All right. I think that was brilliant. So we covered all the way from, starting from the life cycle and, going down to the details of various aspects across asset classes and the compliance and so forth. I think where does this conversation logically take us next? Should we next talk about um, back office, or should we talk more about the performance, so to
I
speak?
think we have covered most of the key aspects of the front office in terms of research, portfolio construction, management, trading, investment risk. I think performance could be a very good segue
Right.
in terms of more of performance of the portfolio as well as attribution. I think more relevant for big asset firms or hedge funds rather than for others. But yeah, that could be a very good topic for us to before we get into back office
Perfect.
accounting.
So I think for our audience, coming up next, topic on performance of the investment portfolio. And thank you once again, Amit. I really enjoyed this session. There's a lot to take in, and hopefully we'll publish this soon to the audience. And thank you very much for
Thanks,
joining, and wish
Asutosh.
you a great 2025.
Sure, and Happy New Year to our
Happy
viewers
New
as
Year
well.
to all of you. Thank you. Thank you.